Hello, I hope you have a nice day. Today's topic is about trader psychology. Trader psychology is a multifaceted and critical aspect of financial markets. It refers to the emotional and psychological factors that influence a trader's decision-making process, risk management, and overall performance in trading. Understanding and managing trader psychology is as important as having a sound trading strategy or a deep understanding of financial markets. In this comprehensive exploration of trader psychology, we'll delve into various aspects of this field. 1. Emotions in trading. Greed and fear, these are two primary emotions that drive many trading decisions. Greed can lead to taking excessive risks, while fear can result in missed opportunities or impulsive exits. Overconfidence, overestimating one's abilities, can lead to excessive trading and larger losses. Loss aversion, the pain of losses is often greater than the pleasure of gains, which can lead to traders holding on to losing positions longer than they should. 2. Cognitive biases. Confirmation bias. Traders tend to seek out information that confirms their existing beliefs, which can lead to ignoring warning signs. Hindsight bias. After a trade, traders may falsely believe they knew the outcome in advance, leading to overconfidence. Anchoring. Traders often anchor their decisions to a specific price level, making it difficult to adapt when the market changes. 3. Risk management. Position sizing. Effective risk management involves determining how much capital to risk on each trade, preventing significant losses. Stop losses. Implementing stop-loss orders helps traders limit losses and prevent emotions from taking over. Diversification. Spreading risk across different assets or strategies can reduce the psychological impact of losing on a single trade. 4. Trading strategies. Technical versus fundamental analysis. Traders often have a preference for one over the other based on their psychological makeup. Trading styles, scalping, day trading, swing trading, and long-term investing each require different psychological attributes and tolerances. 5. Mindfulness and discipline. Mindfulness, techniques such as meditation can help traders stay focused, reduce stress, and make clearer decisions. Discipline, following a predefined trading plan and maintaining discipline are essential for long-term success. 6. Handling losses and drawdowns. Loss aversion, accepting that losses are part of trading and not letting them paralyze decision-making. Adaptive strategies, knowing when to adjust or even temporarily halt trading when facing a losing streak. 7. Psychological profiles. Risk tolerance. Traders vary in their comfort levels with risk, and understanding one's risk tolerance is vital. Personality traits, extroversion, introversion, impulsivity, and patience all play a role in trading psychology. 8. Emotional intelligence. Self-awareness, recognizing one's emotional state while trading. Self-regulation, managing emotions to avoid impulsive decisions. Empathy, understanding market sentiment and the behavior of other traders. 9. Stress management. Exercise and nutrition, physical well-being can greatly influence emotional stability. Mental health support, seeking professional help when trading-related stress becomes overwhelming. 10. Continuous learning. Adapting to changing markets, staying updated and adapting trading strategies to evolving market conditions. Learning from mistakes, analyzing past trades, both wins and losses, to improve future decisions. In conclusion, trader psychology is a complex and integral aspect of successful trading. It affects decision-making, risk management, and overall performance. Recognizing and addressing the emotional and cognitive aspects of trading is crucial for traders looking to improve their consistency and profitability in the financial markets. Overcoming psychological challenges in trading is a continuous process and requires self-awareness, discipline, and effective strategies. Here are several steps and techniques to help traders manage and overcome the psychological aspects of trading. Education and preparation. Thoroughly educate yourself about the financial markets, trading strategies, and risk management techniques. Knowledge can boost confidence and reduce uncertainty. Establish a trading plan. Create a well-defined trading plan that includes entry and exit strategies, position sizing rules, and risk management guidelines. Having a plan helps you avoid impulsive decisions. Risk management. Determine how much capital you are willing to risk on each trade, position sizing. Implement stop-loss orders to limit potential losses. Use a risk-reward ratio to ensure that the potential reward justifies the risk taken on each trade. Emotional awareness. Regularly assess your emotional state before and during trading. Recognize when emotions like greed or fear are influencing your decisions. Keep a trading journal to record your emotions and thoughts during trades. This can help you identify patterns in your behavior. Mindfulness and meditation. Practice mindfulness and meditation techniques to stay present and focused while trading. This can help reduce impulsive reactions to market movements. Set realistic expectations. Understand that losses are a part of trading, and not every trade will be profitable. Set realistic expectations and avoid chasing unrealistic gains. Avoid overtrading. Overtrading can be a result of boredom, impulsivity, or revenge trading. Stick to your trading plan and avoid taking positions outside of your strategy. Continuous learning. Stay informed about market developments and adapt your strategies as needed. Learning can boost confidence and reduce the fear of the unknown. Risk tolerance assessment. Understand your risk tolerance and trade within your comfort zone. Trading with excessive risk can lead to anxiety and poor decision-making. Seek support and feedback. Discuss your trading experiences and challenges with a mentor or fellow traders. Sometimes, an external perspective can provide valuable insights. Take breaks. If you're experiencing a series of losses or high stress, consider taking a break from trading. Clear your mind and return when you're in a better psychological state. Professional help. If your trading-related stress or emotional struggles are severe and persistent, consider seeking the help of a mental health professional. Simulated trading. Practice trading in a simulated environment to gain experience without risking real money. This can help build confidence and reduce anxiety. Review and analyze. Regularly review your trades, both winning and losing ones, to learn from your mistakes and successes. Adjust your strategy accordingly. Remember that trading psychology is an ongoing process, and there is no one-size-fits-all solution. It's essential to be patient with yourself and continuously work on improving your psychological resilience as a trader. Over time, with practice and self-awareness, you can become better equipped to manage emotions and make rational decisions in the ever-changing world of trading. What the role of psychology in trading? Trading psychology plays a crucial role in the decision-making process of human traders. It involves understanding and managing the emotions, cognitive biases, and mental states that can influence trading behavior. Here are some key aspects of trading psychology for human traders. Emotional control. Managing emotions like greed, fear, and overconfidence is essential. Emotional control helps traders make rational decisions rather than being swayed by impulsive reactions to market movements. Risk management. Effective risk management strategies are rooted in trading psychology. This includes determining position sizes, setting stop-loss orders, and diversifying portfolios to protect against significant losses. Discipline. Sticking to a predefined trading plan and maintaining discipline is crucial. Trading discipline ensures consistency and helps avoid impulsive actions that can lead to losses. Patience. Being patient and waiting for the right trading opportunities is important. Impatience can lead to overtrading and taking unnecessary risks. Learning from mistakes. Successful traders learn from their mistakes. Analyzing past trades. both profitable and unprofitable, can provide valuable insights for improving future trading decisions. Adaptability: markets are dynamic, and traders must adapt to changing conditions. This requires a level of psychological flexibility and the ability to adjust strategies as needed. Continuous learning: staying informed and continuously learning about financial markets, trading strategies, and new developments is essential for long-term success. Self-awareness: understanding one's risk tolerance, emotional triggers, and cognitive biases is key to making informed decisions in trading. Stress management: effective stress management techniques, such as exercise, meditation, or seeking mental health support when needed, can help traders deal with the pressures of trading. In summary, trading psychology is a critical aspect of trading for human traders. It involves managing emotions, maintaining discipline, and making rational decisions to achieve consistent and profitable trading outcomes. However, it's important to note that I am not personally involved in trading or trading psychology. I can only provide information and insights on these topics. Finally, we reached the end of the video. This video was talking about one of the best paragraphs that the trader should be familiar with. The next video will be about fundamental analysis and the impact of economic news on financial markets. See you in the next video. Bye.